David R. Guttery is the Chief Executive Officer of inSOURCE Financial Advisors of Lincoln, Nebraska. David Guttery and Seth Edgell are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, CEO of inSOURCE Financial Advisors in Lincoln, Nebraska, to share his thoughts about the Federal Reserve, the economy, and the Magnificent 10. David, thanks so much for joining us. Well, within previous videos, you've talked about these three subjects in depth and offered your thoughts on how these and other factors were contributing to market volatility. So what can you tell our viewers about these concerns today? Have these forces abated or worsened? And how might these factor into the remainder of the year?
Great questions, and yes, I have some updated thoughts on each of these matters that I can share with our viewers. So let's take these one at a time, and let's begin with the Federal Reserve. Personally, I do wish that President Trump would cease in his public efforts to call for the resignation of Jerome Powell. If there are conflicts between the executive branch of government and the leadership of the Federal Reserve, personally, I think those would be best addressed behind closed doors and not on Truth Social. Now, this may be an unpopular opinion, but it's mine, and I'm comfortable in the basis behind the opinion. Were I Chairman Powell, I wouldn't be advocating for a cut to the discount rate at this time either. I think the Federal Reserve is doing exactly what it should do at the present time with the data that's on the table. Then again, I can make a case that both Chairman Powell and President Trump are correct in their opinions regarding inflation and the posture of the Federal Reserve as it pertains to monetary policy. The Fed's favorite measure of inflation is the Personal Consumption Expenditures Deflator, or PCE deflator. In this graphic, we're looking at the PCE deflator ex shelter. Owner's equivalent rent is falling, and pretty quickly. And so, by this metric, inflation stands at 1.9% and below the Fed's stated target of 2%. Now, the European Central Bank has a similar metric that is also at 1.9% today as well. As you can see, our discount rate remains stubbornly at 4.5%, while the discount rate of the ECB is much lower at 2%. President Trump is correctly asserting that a metric that is entirely under the control of the Federal Reserve remains high relative to similar global metrics, and by definition, this creates an economic competitive imbalance. So long as this disparity remains, we are, by definition, less competitive in the world, and President Trump would like to see our discount rate lowered to levelize the playing field. Then again, Chairman Powell is pointing to the tariffs that remain on the table. On the 1st of July, within an interview at a banking forum in Sintra, Portugal, Chairman Powell said that the Federal Reserve would have likely lowered interest rates by now if it weren't for the president's changes to tariff policy. So this isn't about current inflation. The rate of inflationary change has reduced significantly over the last 5 years, and as of today, according to the favorite measure of inflation of the Federal Reserve, it does appear to be below their stated target of 2%. Look, the longer that tariffs remain on the table, well, it becomes increasingly likely that you'll pay more for this pen. In the opinion of Chairman Powell, the Fed can't pour economic gasoline on a smoldering ember after having fought the inflation inferno for the last 5 years. So I see both points, and they're both correct. For this segment, let me close by saying that we are clearly beginning to see the positive effects of round 2 of President Trump's efforts to leverage tariffs in an effort to achieve economic détente. Now, I'll opine on that in the next question, but for now, we are beginning to recognize the geoeconomic and the geopolitical outcomes for which the president sought. Now, you and I can debate whether these tariffs are chess moves or permanent sources of perpetual revenue. The Federal Reserve doesn't have that luxury. They must adjudicate policy moves based on what they can quantify on the table today. And today, there remains too much uncertainty over the future state of the economy as a function of the tariffs. At the same time, we must all remember that the Federal Reserve is an autonomous agency. It is not an extension of the executive branch, and nor do you want it to be. Otherwise, we lose faith in our banking and reserve system. And I think Chairman Powell is doing what he should do at the present time. Now, having said that, every day we get another list of countries with which we've codified new trading agreements. I have no idea where Myanmar is, but I can tell you that we have a trading agreement with them. From time to time, we see a big one, like the UK, Japan, China. The more clarity that we have, then the more latitude the Fed may find in being more accommodative throughout the year. Should that happen, I think this could be a significantly positive catalyst for markets over the remainder of the year.
Wow, that's a lot to digest, but it makes sense, and I'm sure our viewers will appreciate that explanation. So, about the economy, I'm sure this goes hand in hand with your answers regarding the Federal Reserve, but can you give us your thoughts on the health of the economy right now and your outlook for the future?
Absolutely. And indeed, you really can't talk about the economy without also discussing the Federal Reserve. Honestly, I think the economy is in pretty good shape. When you consider such metrics as the ISM Manufacturing and the Services Index, durable goods orders, new orders, factory orders, capacity utilization, personal consumption, and the velocity of money, none of these metrics, in my opinion, are characteristic of an economy in decline. Now, then again, we had a much weaker than expected unemployment report last month, and revisions to previous months were also lower. To me, this speaks of the adverse consequences of a significant shift in tariff policy. If I make widgets, and many of the components that go into the manufacturing of that widget come from overseas markets, and if those input costs are rising as a result of the tariffs, then it stands to reason that I might put plans for expansion on hold until I have greater clarity regarding my cost of manufacturing. Then again, as we get greater clarity regarding tariff policy, and if that translates into greater latitude for the Federal Reserve to be increasingly accommodative, then I would likewise anticipate a significant snapback or improvement in such employment metrics as a result. I can make a case supporting in the second half of the year an economic surge should we continue along this path. Then again, if tariffs linger for longer and uncertainty continues to be problematic, then I can make a case for such being a catalyst for economic stagnation. I think we have a unique opportunity to look back at Trump 1.0 and remember what happened the last time. Do you remember NAFTA? Well, we didn't achieve that without much saber rattling and bluster over tariffs then either. Now we're trying to negotiate NAFTA 2.0. Did it work the last time? Indeed, several economic metrics hit all-time record highs between 2018 and 2019. Can you say that those records were 100% the result of NAFTA? Well, maybe not, but then again, we didn't have those highs until we had NAFTA, and we didn't have NAFTA until we had the saber rattling and the bluster. So let's all be patient and see if we get a similar result this time. Every day, it seems that we're hearing more and more about companies that are repatriating manufacturing activity back to the United States. Well, we heard the same thing in 2017 too. Over the ensuing 12 to 18 months, we saw several manufacturing, industrial, and economic metrics hitting all-time record highs or near-term highs, and clearly all of that activity was positively correlated. I can cross-check this with another metric that is publicly available from the Atlanta Federal Reserve Bank: wages. We've heard a lot about how the economic policies of this president are geared toward the ultra-wealthy and the billionaires. Well, by the numbers, that didn't seem to be the case over the first 3 non-COVID years of Trump 1.0, as evidenced by this metric from the Atlanta Fed. Now, I had to blow the dust off of this graphic from several years ago. The Atlanta Fed tracks employment data across many genres of employment. Over the first 3 years of the Trump presidency, the employment group that saw the greatest average annual income increase were those in the construction and mining area. All right, you may have a few billionaires in that genre, but you have all of the trade unions. So this is where you'll find the blue-collar industrial workers who are the salt of middle America. From 2017 through 2019, their wages grew by an average of 6.8% per year for 3 years. That same employment group saw their wages grow by 1.7% per year for 8 years under President Obama, and only by 0.7% per year under the 8 years of President Bush. By this metric, I think you can clearly say that indeed the economic policies of Trump 1.0 worked the last time, and I think it's reasonable to anticipate a repeat under Trump 2.0. It's all interwoven. Nothing exists in a vacuum. One domino will impact another if it is set into motion, and right now I see an economy that is in pretty good shape, all things considered. The question is more about what happens next. A booming economy or a stagnant economy remains in the balance.
Great information, and thanks for the history lesson. Well, hopefully we will indeed see the booming economy rather than the stagnant economy. Okay, last question. You've talked a lot about the Magnificent 10 and how skewed the market is right now because of this narrowly focused sleeve of the market. Do you have any updated thoughts to share with our viewers on this topic?
We could devote an entire video to just this one topic. So speaking only for me, he who forgets history might well repeat it. We've seen an event-driven, rapid adoption of technology before, remember Y2K? And before anyone says it's different this time, think again. It is never different. But that's what we tell ourselves for comfort. That's what they said about RCA in 1929, and about housing in 2008, and technology in 2000, and aluminum in 1958. It's different this time. Or is it? How many parabolic moves do we need to see build and burst to understand that the forces that build bubbles may be different, but the outcome rarely is? So let me ask, which was the last parabolic move that you remember that never burst? I'll wait. At the beginning of the year, we observed that 40% of the S&P 500 index was represented by 10 stocks. This overconcentration pales in comparison with the imbalance that we saw leading up to Y2K. There are 503 stocks in the S&P 500 index, and 10 of them controlled 40% of the weight of the index at the beginning of the year. So has that changed? Nope. As of the 6th of August, 38.1% of the S&P 503 remains concentrated in only 10 stocks. And it gets worse. 15.5% of the S&P 503 index is represented by 2 stocks. In the nearly 34 years of my career, I have never seen anything close to the market imbalances that we have today. So, when you read bombastic headlines like this, please take it with a grain of salt. This might otherwise get my attention if the S&P 503 wasn't 40% skewed to only 10 stocks. Take those 10 stocks out, and you get a much different picture in terms of valuation. In my opinion, no, the remaining non-magnificent 10 side of the market is not overly valued. It is especially critical at the present time to not be satisfied with superficial observations. You must look more deeply than just the surface to truly appreciate what's going on. By the way, the warning signs are evident and they are publicly available, and they've been there for a while. Using hedge funds as a reference, the level of bearishness among these AI thematic stocks has never been lower. Again, we've seen this before. I don't care what the technology might be. If the anticipation of productivity gains and efficiency and cost savings that might result from the technology isn't supported by earnings and revenue, which it doesn't appear to be at the present time, then at some point, it's reasonable to expect a correction. I don't know when this video might air, but on Thursday, the 20th of August, this article appeared in the Financial Times. I have also seen other recent opinions in publicly available spaces such as Yahoo Finance, like this one, among others. Over the course of my career, I've come to understand that once you see subject matter like this being discussed in a free, open to the public kind of forum, then the cycle in question may be coming to an end. Remember the 27th of January? All it took was a rumor from China regarding a new technology called DeepSeek to send the technology and these AI thematic behemoths reeling on Monday the 27th of January. I don't know what might be the next catalyst to cause the market to capitulate, but we've already seen it once this year. And in my opinion, warning signs are everywhere and evident, and at a time when, in my opinion, there is discernible value to be found in the other 10 sectors of the economy. So I can't give investment advice to the general public in a medium like this, but if you're asking me about my personal view on the Magnificent 10, AI thematic part of the market, it would simply be to evaluate the risk of this or of any investment against your tolerance for taking risk and as a function of the goals you're trying to achieve. And in the process, evaluate whether or not there might be better potential for growth for within sectors that might not be so overly valued, and make that personal call for yourselves. It's when people become complacent that adverse consequences can occur. So in closing, look, as I've said in virtually every other video, pay much more attention to the goals you're trying to achieve, more so than the stock pick of the day. Work with a professional who can codify those goals into an actionable, long-term plan, and then let that plan drive the allocation of the accounts that you're leveraging for the achievement of the planning goals. When you have a long-term, planning-driven perspective, it helps shift the attention away from the minute-to-minute and back to the year-over-year view.
Well, David, as always, thank you so much for this information and for additional information. David may be reached through the means listed upon the following screen. For inSOURCE Financial Advisors, I'm Brannon Dawkins.
David Guttery and Seth Edgell independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.